Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and the odds are you're watching this video because you got an email from me by being a member of my free email list saying, hey, it's uploaded and ready for you to watch. Now, if you're just randomly watching this on YouTube, click the subscribe button with the video and then click the bell next to it. That way, YouTube will alert you as soon as the next video is uploaded, because we're in an interesting moment now in the financial markets. The election has passed, and then Monday, we came out with news that there's some positive results of a Pfizer vaccine that looks very promising, 90% effectiveness so far in what is roughly halfway through stage 3 trials. And the market exploded higher on that news, although we didn't really see the Nasdaq participate. And today, the Nasdaq is red. So what do we make of all this, and where are things going? So what I'm going to do is kind of give you a big picture forecast of how I think the market is going to act over, let's say, the next 10 months or so. Now to do this, I need to share my screen so you can see some of the things that I am seeing. First of all, this is an article that I wrote before the election. And during that week, the market was dropping in the second half of October. And there was a lot of talk out there that it could actually collapse if there was dispute following the election. Well, the Tuesday election day came, and there is a dispute over the election from Trump saying he's the winner, and the market went up anyway, and of course it exploded yesterday. And when I wrote this article, I was saying, look, the election is going to come, but the market is likely to rally, not because of the election, but because what traders are doing in the markets is they're always looking for the next event. If it's going to be a bad event, they typically will sell into it. And then when the event turns out not to be as bad as people expected, there's a relief rally. Sort of that's what happened with the election day. But then what I expected them to buy into after that was what would be an announcement from one drug company or another of positive vaccine testing results. Buy the rumor, sell the news. Well, that news came yesterday, and we had a tremendous gap up. So how are things going to trade out next? Well, the market is so far trading. Oh, and by the way, if you want to get the articles like this one, you got to subscribe to my free email list. So if you're watching this on YouTube, click the link associated with this video to do that. Now, look, the market is trading a little differently than it did in 2016 following the election of Donald Trump. So in 2016, this is what happened. We had a tremendous rally going into the end of the year. Then the market traded sideways and broke out again. It had a great 2017, and then it had what was some call it a flash crash in 2018, a 10%, a little bit more drop from a parabolic high, in which things got extremely overbought and simply stalled out. So here we are. We're a little different though. The market is not as going up like it did exactly when Donald Trump won. And one reason why is there was movement in a lot of sectors that had been lagging the market for well over a year that came alive after Trump won. There were special Trump-favored sectors that saw a big rally, industrials, steel companies, and so forth, that just took off and did very well for much of 2017. But now, I think that the rally we saw after the election was simply a continuation of the pattern the market entered into following Labor Day, not a major top leading to a crash or a massive decline. We had a 10% pullback after Labor Day, But I think instead, what we are seeing is the establishment of what will be a range-bound market. When the market rallied from March to Labor Day, it went up 70%. And when a market or a sector goes up 70% in a short amount of time, it gets extremely overbought. And that leads to a sideways action, a trading range zone. So if we step back and look at a 20-year chart of the S&P 500, we can see that we saw extreme price movements down in March and then up into Labor Day. And if you look at the 90-day rate of change indicator at the bottom of this chart, you can see it took an epic plunge, the fastest plunge ever, in fact, on this indicator for the S&P 500, and then the fastest jump up too into Labor Day. And this indicator typically trades in a 10% range or 15% range in any given year, range bound up positive 10, negative 10. It's what it was doing really for 10 years. That pattern obviously got shaken, but I think we're going to return back into that pattern over the next 10 months. Another indicator that measures the volatility in the market are the 200-day Bollinger Bands. They're the pink bands enveloping the price chart, and the width indicator showing the width between those two bands is this indicator right below the chart. And you can see it got to 80 in 2009. That was after a horrible bear market and two big declines, the first in October or the fall of 2008, the second in the spring of 2009. Now, we didn't see declines of that sort this year, but we saw this width indicator get to 40, and it's probably going to return back down to 20 over the next 10 months. In other words, we're not in a position to see the market rally like it did after the election of Donald Trump in 2016 and just go up at a 45-degree angle, for the next 12 months, but instead establish some sort of range-bound market. And that's why we're not seeing the Nasdaq big cap tech stocks explode as the Dow has done this week. They were already overbought, and instead we're seeing a market that can stay fairly bullish looking day by day, but not really run away from anybody. But the bullish action is maintained by consistent and constant sector rotation out of overvalued stocks, overbought sectors, into sectors that are oversold. And this pattern can churn and churn over the next 10 months. This is sort of what we saw the stock market do in 2015, what it did in 2018, what it did in 2012, what it did in 2013, what it did in 2004, 2005, 2006. This is the sort of phase we're going to see in the stock market. So that's how do you make money? Well, it actually becomes difficult to make money trading the market averages unless you're some sort of day trader. And instead, easier to make money being in sectors that are vastly outperforming the stock market averages, not really trading with them, and buying oversold things when the market does have its periodic pullbacks off of a high. And that one we saw on Labor Day, I don't think it's going to be the last one. I think we'll see another one. I'm not sure when. I don't think it's starting now. To me, it looks like we're going to see the market float at this current level into Thanksgiving or something. I don't really think much is going to happen one way or the other, which is fine. But we're seeing action, I think, in gold, in mining stocks, which have been outperforming the stock market all year to date, up much more than the stock market this year, gold and mining stocks and silver and the GDX ETF. But actually, they've been outperforming the market since 2018. So we saw them take a hit on Monday. I think that's a buy point to get positions in there. So that's a situation I'm closely following. There's other sectors I'm closely following. So this is, I think, still a great environment for trading, for buying, a difficult environment for shorting most stocks. There may be some stocks that are going to start to falter, stocks that really are questionable, but that, I'm not talking about popular stocks, just strange ones, really. But that's a topic for another time. And I'm not really trying to short stocks at this moment. I'm more interested in buying things trading better than the market, because if you want to beat the market, you want to be in the things beating the market. It's simple as that. So anyway, these are my thoughts now. To sum it up, we saw all kinds of news, the election news, still ongoing, this vaccine news, and I think there's going to be other drug companies coming out with vaccine news from now to the end of the year. An overall bid under the market, but not an exploding market after Monday's action, but more a range-bound market. I think that's going to be the case now for months. And we've seen markets that can trade like that for an entire year. So I think that's the type of environment we're heading into. Look, the stock market went up 70% from March to Labor Day. It was unrealistic after that move to expect another 70% gain immediately following that. No, instead we're getting this type of market situation, range bound, consolidation if you want to call it, but range bound. And markets are either going up at a 45-degree angle, they're falling in a bear market, or they're range bound. We're now range bound. And you recognize that overall trend and you adapt to it. What tactics are best in a range-bound market? Well, unless you're trading the averages by getting out when things are overbought and buying when they're oversold, the best way is to be in there, is to look for stocks outperforming the averages, trading on their own. Instead of buying things gapping up on Monday, the thing to do is look for things breaking out this week out of consolidation patterns. And there are things doing that even today as I'm speaking. So those are my thoughts. Again, if you're watching on YouTube, subscribe to my email list by clicking the link associated with this video, and subscribe to this YouTube channel by clicking subscribe and clicking the alert bell that YouTube will send you to tell you that the next video is up.